Hello, and welcome back again. After talking about Chipotle, it's about time to take a look at Jack in the Box, another very well known fast food joint in the US. I'm not sure if it's available in most countries in the world, I don't think so, but it's a big thing in the US. You'll see that it has a high beta, it means that it's a pretty volatile stock, and it's an old IPO, 1992. Doesn't have as many employees as you would expect. But what we do want to take a look at is how they are doing in terms of the financials of the company. First off, let's examine whether we have any news about the company right now, because I love this module. I always take a look at it. It gives me ideas about the company and a lot of information about what's going on in the world concerning this stock and any stock that I actually query. And you will see here that this is talking about some expansion that's interesting. It talks about general news and things about Jack in the Box being an interesting and a good stock to buy compared to peers and things of that sort. But in order to see whether that's the case, we want to be using our tools here because they can really help us deduce whether it's a good idea to buy Jack in the Box or not right now. Now, this one, of course, is a company that is a very well known retail store, food store pretty much, in the US, and it's in the restaurants industry, of course. And let's take a look at what they are doing. First of all, the stock price. We can see the max chart here. You will see that it started back in 1990 at about $7, and it's right now at 92. It has been 124, so people who bought have been doing pretty well, actually. And if you take a look at the 5-year chart here, you will see that it has been relatively steady. It went to 100 with a massive decline at some point, but then again getting back to 100. So pretty much trading at a range over here of about 80 to 100 for the most part. And right now it's down quite some. And again the max chart here with a massive drop and all that jazz. But we want to examine what is going to be happening with our investments here. And so let's take a look at whether the company is actually interesting in terms of adding to a portfolio right now. First thing that I notice here is that 6 out of 8 of these key metrics are actually check marks here. Let's take a look. 12.5 PE ratio here going down. I like to see that, of course. And the same thing with the price to free cash flow ratio. I'm always interested when I see these kind of two first key metrics being check marks. Outstanding shares also going down. The company is massively buying back shares. Love to see that as well. They are actually thinking that their stock price is cheap right now and they're buying back. That could be the case. We'll examine that. A little bit too many total liabilities when compared to the free cash flow that they made last year. We typically want to see that at about 5 years. This means that it would take them 16 years of their last year's free cash flow to pay all their total liabilities, and it's a metric that we can use to deduce how many liabilities plus debt pretty much the company has that they would need to fulfill at some point. It gives us a very quick overview, and the revenue growth is about the same. As you'll see, the company is sitting at the same range. It had a little bit of a drop and then climbed back up in the next few years. So yeah, at some point they were not doing that great. And net income growth keeps growing right now. Free cash flow growth also growing, and total equity growth actually going down here and being in the negative. That's very interesting to see. We will examine what's going on. Now, the debt to equity ratio is negative because they have negative equity, of course. They seem to be having quite some debt as well. But the dividend yield that they are paying is 1.9, almost 2%, with a pretty low dividend payout ratio, so they definitely can serve this one for a long while. They have a bad return on equity, of course, that you'll see here, but a good return on capital employed or invested capital is similar but not exactly the same. Okay, let's take a little bit of a look actually at the financial statements because this is an interesting one. Now, they have been actually dropping their revenue for a while and then actually picked up, and so they are doing right now what they were doing in 2017, so they haven't really grown. That's very interesting. This can actually prompt us to keep our revenue numbers low when we examine it in a stock evaluation tool. Now, if we take a look at the net income here, you will see that it follows the same pattern as expected. It used to be 135, then went down and then picked up again. Same thing as with revenue, which we would expect that actually. What's going on with the balance sheet here is interesting. So the total liabilities of the company are sitting at 2.5 billion, but the total assets are sitting at 1.75. So that's a significant difference of about 800 million here. And this seems to be going down as well every year. And I'm actually a little bit surprised that they keep buying shares for the most part. Yeah, I guess they think that it is they are cheap right now, and so that's why they do that. But their equity is actually going down. Okay, that's not necessarily a bad thing, as you know. We have examined McDonald's before, and we also have a company that's has decreasing equity. But it really matters to understand what the company is doing financially, because they can be doing that on purpose, as McDonald's does. And the same thing could be happening here. So as long as I have a company that's making good free cash flow, I'm not that concerned. Now this one is making probably sustainable enough cash flow for what they are doing, but not at the same level that McDonald's is at, for sure. So this is something to bear in mind, the fact that they are going negative in terms of their assets here. Now, the net cash provided by operating activities, as you will see here, is positive, is of course a good thing. It's about the same though, not much growth. And investing activities, a little bit of investing going on. For the most part, is almost close to zero here. Financing activities, the company for the most part again is repurchasing stock, as you'll see. It's the big thing about the company, paying back some debt, normal things, and a little bit of dividend. Dividend is very sustainable, generally speaking, compared to net income. We saw it's about 25 to 30%, something of that sort. Free cash flow, 104 here, went down on a while, and then crept up again, 160. Pretty nice right now. Okay, let's take a look at the stock evaluation tool to try to deduce what kind of money we should be paying for the stock right now. What kind of price? Revenue growth in the last 5 years has been negative. It looks like these years can really skew things downwards. They have been doing better here, yet I'm not gonna go that high because there have been negative years. I'm gonna go low. I'm gonna go 1, 2, and let's go 4 here for our revenue growth. So I also have a scenario where it's almost zero growth every year, like 1%. Let's see how that plays out. Net income margins overall 11.9%. It's almost the same every year. So I'm gonna go, let's go 9, 10, and 11. Makes a ton of sense. Free cash flow margin 100% is pretty legit. And I'm gonna go 80, 90, and 100. I could even go 100 everywhere here, really. Again, this is something that you can utilize and play with when you get access to the tool. By the way, remember to subscribe if you want to get access to the tool, because it's about to be released very soon. You want to be around for when that happens. And please like the video as well while we're at it. That really helps the channel. Let's actually add an annual growth of 13% is what I typically want to be making out of stocks, individual stocks, and hit calculate. What are we getting back? So for our high estimates, we are getting a price of $94, which is our max price to pay, of course, while the company stock price is at 92. So for our high estimates, this would be a buy. This is a 4% revenue growth that they can definitely achieve. And all the other numbers are exactly where their pretty much averages are. So this is very fair here. This is very achievable. Now, would I buy Jack in the Box? Well, it's interesting. I mean, it's an interesting proposition. I mean, I definitely wouldn't completely dismiss the company for sure. It looks like an interesting buy. I think that right now there may be better buys in the market, yet I'm gonna be paying some attention to this one and see whether it actually goes down even further. Because if it goes at around maybe $60 to $70, then it starts becoming a little bit of a better proposition here. So at these levels back in 2020, I think it was an interesting purchase over here. Right now, I think it's a little bit more expensive than what I would like it to be, even though it's within our range, at least for the high estimates though. So I'd like to wait it to go down a little bit if that happens. Otherwise, I would probably move to another one right now. But it's an interesting, again, it's an interesting proposition, doing relatively well here. A little bit more debt, but and the negative equity here. But again, this is not necessarily concerning for companies of that sort. You can see these kind of things at McDonald's as well, and the company is doing awesome. So yeah, just bear in mind what's going on here, and let me know what you think about the company with a comment below. I'd like to hear what you think about it. I think it's a company that deserves at least being at the short list of somebody. Maybe an interesting purchase for when it drops a little bit. Thank you for watching this one. I hope you enjoyed the video. If you did like it, take a look at this video that I made earlier. It's about Chipotle, another fast food joint, very well known one. And thank you for watching this one as well. And yeah, I'll see you in the next one very soon. Bye bye.